Hello, everyone, and welcome out to your Maverick Currencies midweek for July 27th. Corey here with you, and of course, it is FOMC day, so we're going to have a Fed likely hike by 75 basis points. There's still a little bit of debate whether they'll go 75 or the full 1% hike. As always, a quick reminder to make sure you follow your trading plan, and let's get to it. So, first, a quick review of kind of where we've been and where we're headed. Stocks have broken out above the 20 and the 50-day and above the prior swing highs and so forth. But where do we go from here? While I was optimistic on markets and, I still think we can go a little higher, we're probably in more of a choppy market than anything else. And unfortunately, I think that's also true for the FX markets, for crypto, for just assets in general. Things go through cycles, and this will be a short cycle. We're talking a few weeks or whatnot, but you've kind of been seeing volatility dying down. That tends to happen when markets are rallying, right? So volatility and asset prices move in opposite directions generally. So asset prices go down as volatility goes up. Fear, right? Fear and nervousness and just overall volatility, they kind of move inverse. Well, I think we're going to be in a little bit of a it's not that volatility is going to go away, not at all. I mean, you're going to see some volatility, but I think it's going to be contained. So my expectation is that unfortunately it's not going to be a real trending environment. I don't think we just take off to the upside and don't look back or really break down and head to new lows quickly. Instead, I think it's going to be a lot of kind of false starts, so a lot of up and then back, and in FX it'll probably be similar to that. So we've touched on the US dollar kind of hit an exhaustion high. Excuse me. I'm getting choked up just talking about the US dollar. They print so many US dollars it started choking me with, you know, I was getting to it. No, I'm kidding. But exhaustion high in the US dollar. We talked about that top and kind of the after the breakout and all of those things. And we're going to be trading the dollar. There's a couple of ideas that I have that are, for different time periods. So if I want to trade the US dollar up, I'm going to do it probably on more of um, a 1 hour time frame, and if I want to trade the US dollar down, I think I'm going to do it more on the 4 hour time frame is how I'm looking at it. But we'll make sense of that here in a bit and kind of see the reaction. Commodity prices, so natural gas has hit a new high not seen since 2008. Now, that's a long time, and natural gas hitting a new high. But interestingly enough, as we've touched on for a while now, and I really think this makes sense. Energy is the commodity that's holding up. And the reason for that makes sense. I mean, Europe has a real energy crisis. They're going to be importing nat gas. There's expectations they don't have enough for the winter season. It's a real supply demand situation. Whereas if you look at the demand shocks in other commodities, I mean, lumber prices have been cut in half or more, down more than 50%. Why does that make sense? Well, it makes perfect sense. People are probably not building like they were before. So there's a natural demand, an aggressive demand for energy that's maybe not there in some of the commodities like steel and lumber and copper and aluminum and so forth. On the economic reports, the Aussie reported CPI of 1.8 versus the 1.9% expected, and consumer confidence continues to be lousy, 95.7 versus the 97.3 expected. We've been seeing consistently consumer confidence numbers that are extreme lows. I mean, terrible lows. So in terms of 50-year type of lows, that sort of thing. So in terms of consumer confidence, just down in the dumps. All right, let's make sense of a few things here. For the week, not much happening. I mean, this is pretty neutral. Crypto moving 6%. That's almost a neutral move for crypto right now. Oil moving 3%. That's a nice bounce back in the oil markets. But let's take a look at a few of these things. So The S&P chart here, we've broken above downtrend lines. We pulled back to the 50-period moving average yesterday and are bouncing. I suspect, the Fed meeting is going to bring about volatility. You're going to see either this gain go away or be built upon, but a lot of it should be priced in. The idea that this is just going to it'll have volatility for sure, but the idea that it's going to be, something huge and catastrophic, I think for the most part it's priced in at 75 basis points, and I still expect the Fed's going to hike by 75. They could hike by a full 1%, but again, I'm not even sure that would cause a knee-jerk reaction that would be more volatile. But even that, I'm not sure would be, anything too dramatic. As we look at currencies, pretty flat. A little bit more weakness in the yen, the euro, and the Kiwi. A little bit more strength in pound and CAD, Aussie and US dollar, but relatively flat and choppy. All of crypto is down across the board. It's actually, crypto's had a pretty good couple of weeks, so it's kind of pulling back into its range. Really couldn't take off, but it's hanging in there pretty well, relatively well, of late. Been in a little short-term upward trend. So let's go look at some charts and really get prepped for the Fed meeting here. I'm going to pull up a couple of different things. First, let's talk about our calendar of events. So let's talk about this calendar. Here you can see the Fed meeting. 1.75 is the current rate, expected to go to 2.5. Could be, again, it could go to 2.75, possible. And there will be a press conference after. Sometimes that can create more volatility than the actual release of the statement. What's going to be really followed is the Fed statement, and they're going to have to talk hawkish. They're going to have a hawkish tone, basically talking about that they've got to get inflation under control and so on. So the message should be quite, dollar bullish. It should be something that drives the US dollar higher. The problem with that thesis is that, well, everybody kind of knows that they're coming out with big rate hikes and going to talk about inflation and needing to. So, is it already priced in? Is it already a known factor? Yeah, to a large extent. It's going to take something extra. It's going to take something that was not anticipated, not expected, to really get that extra leg of volatility. Advanced GDP comes out tomorrow. Expectations for this are about flat. You'll notice that there's been a big discussion. The White House sent out a statement of how they define a recession because they didn't want negative consecutive quarters of GDP to be considered recessionary because we're headed that way, So it depends on your definitions and whatnot. But here's, I guess, the point. You don't even debate these things if you're not in or close to a recession, right? You wouldn't even be having this discussion. So whether we're in a recession, whether we're we're in that mode, right? We're in that phase of it really doesn't matter. It's what the, whether you define it as this or that, from a market perspective, we're close enough to a recession that we're having the discussion. That's all that needs to be said, right? Now, if there are signs that this thing turns into a deep recession and really gets ugly and so on, that's a different ball game, right? And so is it a shallow recession? Is it a really aggressive? What's interesting about recessions is that historically they've been normal and not anything to be too fearful of. And frankly, the markets, sell off a little bit and then they rebound back up and it's nothing too dire. The problem with humans is that we're always so nervous about what we recently experienced. Recent experience creates a deeper effect in our mind. And so, because recent recessions have been so unnerving, you think about the global financial crisis in '08, you think about COVID and how people felt and how nervous people were about, what's going to happen with the healthcare system and all of the fears. And so we're attaching that to recessions because the two most recent recessions were severe. But the reality is that that's not how most recessions are. So I think there's a very good chance we could go back to a normalized recession, which just frankly isn't the end of the world. So, that's my take on it, but we must be, obviously in that vein of we're somewhere around a recession or we wouldn't be having this conversation. So as we come over to charts and think about what to trade, I kind of made mention, so somebody asked about, what was it? Kiwi Swiss franc, I think, and Aussie Swiss franc last week. And I said basically, they look like shorts. This is the daily chart. They'd hit the upper Bollinger Band and below the 50-period moving average. And sure enough, we're selling off. So even though they looked okay on different time frames, that daily chart is important. It's impactful. And we've sold off from there. Well, if you look at Kiwi US dollar, it's not, Kiwi Swiss franc was there about, well, a week ago, right? Last Wednesday, we were touching up there. If you look at Kiwi USD, it's happened in the last 3 to 4 days. So last week, we were a little shy of that. We pushed a little higher in the Kiwi versus the US dollar, and now we're fading off. But what does it look like? Well, it looks like a short, right? It looks like Kiwi versus the US dollar could be headed back down to the lower end of the range. That's possible. I have had a thesis that we've actually hit a temporary bottom here in things versus the US dollar, right? So for this to go lower, you'd have to have Kiwi, Aussie, those things going down and US dollar going up. And my thesis is, from this point on, I think the US dollar's hit a little bit of a bottom. So that the flip side of that is, well, maybe we're going to hold here. Maybe this is the level where we kind of bounce and we work our way, and it is a trend reversal, which has kind of been my thesis, that the dollar probably hit its top, which means this has hit its bottom. If the US dollar struggles here for a while, this should work its way higher. So I could kind of go, a number of different ways on that in looking at it on the daily chart. If we were to compare the US dollar to other defensive currencies, let's go USD yen. Well, US dollar's in an uptrend versus the yen. Let's go USD Swiss franc. It's in an uptrend, well, sideways trend, let's call it, versus the Swiss franc, which really tells you how strong the Swiss franc has been. We know how strong the US dollar's been, and the Swiss franc has been, better than the US dollar, but sideways. So if you're looking at these, you kind of say, the reason I bring these up is there's risk on, risk off type of currencies. I'm more inclined, if I'm going to play, if I'm going to play Kiwi down versus the USD, or even the Aussie down versus the USD, I think those are the trades to take if you're going to be shorter term. I'm talking 1 hour chart, maybe even 15-minute chart. I just don't like that thesis big picture. I don't think that that's where it's headed on a multi-day, multi-week basis or anything like that. So I'm kind of looking at those as short-term downside trades, and that gets you bullish US dollar. So if I'm going to play the US dollar bullish, I'm going to probably do it against Kiwi, would be my first choice, but on a short time frame, meaning I'm getting in, I'm getting out rapidly, rather quickly. Could I be in for a couple hours? Sure, but I'm not going to be in it for days and so forth. Now, if I do play the US dollar to go up, or pardon me, to go down, okay, so we switch it. If we want to play the US dollar bearish, here we're bullish, would be the idea, right? Here we're bearish. on USD. I think I like doing that against the yen, or maybe even more so for me, the Swiss franc. Maybe I should have put that one on the top, but that's fine. So we're playing those to the upside. There, I think you could kind of extend your duration. I'm okay with that trade, having progression and maybe going a bit further and going for a while and such. So if that's your thought process, I kind of like that on the 4-hour charts on a little bit longer time period, a little bit longer scale, actually. So 4-hour charts on these, really a shorter term chart on those is the way I'm looking at it. Let's look at the 4-hour. Let's say we were going to play the US dollar on the 4-hour versus the Swiss franc. It actually has a bearish Bollinger Band setup. Do you see it? Hit the upper band below the 50 period moving average, should trade down. And you can call this a low base, whatever. It's patterns within patterns, which we always love. And all of them bearish, right? The trend is bearish. The pattern setup, we're at the top end of the range. It's bearish. We should come down to that support, breakdown. And this one, I think you can be patient. This is a 4-hour chart. We might be in this for a little longer period of time. You might trade this into tomorrow, expecting a move down there into the 95s on this currency pair, where you'd be looking to take profits. Your initial target is probably down in that range. Why? Well, just measure the trading range here, and you'll probably make an equal size move down here. So if we were to eyeball this, not a perfect science, but let's call it 96, it's probably 96.60. It looks like up there at the top, and we could even put our cursor on it, kind of see what one of those highs was. That's 96.59. Okay, close enough. 96.60. And then if we look down here at the bottom of the range, you're down here at about, I'm going to call it 96.05, something like that. You could call it 96 even, but I'm going to give it a little less. I'm going to call it 96.05. So it's about 55 pips there, right? 0.55 is the size of this trading range, kind of top to bottom. So as you break 96.05, you should go down about 55 pips to about 95.50. That number minus the 0.55, that's the size of this trading range. If we break it, we should probably extend about that far down. That equals about a 95.50 target. We're not going to get to 95.50 in the, likely today. So you're probably going to be holding that into tomorrow and that sort of idea. So that's dollar, Swiss franc. US dollar, yen doesn't look quite as good. That's why I said I don't like it as much, but I think it's a similar approach. Why don't I like it? Well, I mean, it's not that I don't like it. I actually think it's fine as a bearish setup. You have some prior retests and so forth, and we're coming up to that. You're at the upper Bollinger Band. You're still just by a thread, just barely, but you're hanging below the 50 period moving average. I'm fine with all that. The reason I said it doesn't look quite as good is the long-term chart. The long-term chart in USD yen is still in an uptrend. The long-term chart in USD Swiss franc is in sideways or even a downward phase. So it's preferable from that standpoint. I'm not sure you're going to be in long enough for that to matter. We're talking a couple of days. So if you prefer dollar yen, and we might look at this. By the way, the risk to reward on dollar yen is fantastic. I mean, it's a really easy one to trade from a setup perspective because you're right at the 50. So, I mean, your stop out point is just right next to you, which is kind of a good thing. If you're wrong, you'll get stopped out quick, relatively painless, because it'll be a small number of pips and it'll happen. We probably won't enter this before the Fed announcement, but it'll happen rather quick. I mean, if we get triggered in at 137.20 and then it trades back up to 137.48 and stops us out, it'll happen probably within the hour, right? Relatively quick, and it's 20 some odd pips or whatever, 30-ish pips. Okay, not that big a deal. But if this thing works, I mean, even if you could just go down towards the prior low that we touched, that's a couple hundred pips. Now, I think that's too aggressive and too, probably excited about where this thing might go. I'm not so sure that it is going to go, um, that far. At least, I mean, it'll probably take multiple days to get a couple hundred pips out of it. But even if you were conservative and just said, hey, even if we just kind of come back down here, down towards this range, you're talking about probably a 3-to-1 reward to risk ratio. If you could just get down to the lower Bollinger Band, you're probably at 4 or 5-to-1 reward to risk ratio. So I think in terms of both of these setups, all of these setups, you're better than 1-to-1 reward to risk, which I like and I would prefer. I don't know that I would take any of these if you were just playing it pure 1-to-1. I think you're okay to do that. It's probably a little better than 50-50 probability on any of these setups. But I'd like to squeeze out a little bit more. Now, it doesn't have to be 2-to-1 or 3-to-1, but a lot of times, if you're risking 30 pips, you'll at least make 40 or 45. You'll make that little extra, 1.5-to-1 or something reward to risk. And it depends. You can always, manage the trade to where it ends up you expected to make, hopefully a 3-to-1, but you saw something that told you to take your profits when it was at 2-to-1. What about pound USD to the upside on a weaker US dollar? So let's look at it. We'll go daily chart first. So pound USD on the daily doesn't look so good, right? It's been in a deeper downtrend. 4-hour, it does look better, much better, so it's kind of a case where if you said, what's the long-term trend? Well, that's been down, but all of these shorter-term trends look like they're turning positive. The 4-hour chart kind of setting up here, ascending triangle type of pattern, right? Possibly poised for a breakout. If we come in, that's on the 4-hour. If we come into the hourly chart, you can see the same setup, just a little different time period, but still the same concept, right? Ascending triangle. I mean, the short-term charts look like they want to break higher. The long-term chart is not, we're not in a bull market yet, but I kind of think that the dollar has stalled here, US dollar. I don't mind it as an idea. I think it was maybe a little bit easier to kind of look at this from the standpoint of the symbols that we talked about, where if you're playing the US dollar down, at least you have the backing. Like the Swiss franc has held up against the US dollar better than all the others. So if you are going to get that US dollar weakness, well, that trade should work, and maybe the Swiss franc can just be stronger on its own, even if the dollar's not going down. So that's kind of where I was focused on that one. All right, so we're getting ready for the announcement here. What happens if there is a full 1% hike? That's a good question. If they go up by 1%, well, the first thing you would expect is all of these charts, US dollar would be strong. So my anticipation would be something like this. Pound USD would reverse hard this way. It would turn red in a hurry. The knee-jerk reaction, if they come out with a full 100 basis point rate hike, would be big red candles in something like pound USD, right? Because the US dollar would probably shoot higher as the knee-jerk reaction. I'm not so sure it's bad big picture if they do that, but in the near term, that's not what the market has priced in. So this is a we talk about sometimes there's knowns, sometimes there's unknowns, and sometimes there's combinations. Well, we are in a known unknown. That's what this Fed meeting is. We know it's coming, we know the date, we know the time, and we even have some built-in expectations, but we don't know for sure. There are some unknown aspects to it which create some volatility. This is not as volatile of an event as if it was an unknown unknown. What if this was one of those emergency Fed meetings where it wasn't scheduled, but yet they just came out and hiked rates by a full 1%, Then you'd have all the unknowns of, okay, well, what does this mean for the economy? What does this mean for the consumer? What does this mean for corporations? What does this mean for currency? So you'd have all the unknowns, but it would have been in no way, shape, or form priced in. In this meeting, we should have a good portion of the rate hike priced in, right? It's already known. We know we're going up by at least 75. So this is not a shock, not a surprise. If they came out with 100, well, it hit you with a little bit of unknown. Would the dollar spike up, meaning this chart would spike down? Yeah, the dollar, would spike up. If they come out with 75, I don't think then that's a given, because that, again, should be somewhat of the known portion. We know they're going up by 75. There's just a little bit of an unknown whether they're going by 100. So it's hard to guess, because sometimes, if they go up by 75, theoretically, higher interest rates should be dollar bullish, but that's ahead of time, right? It gets priced in, and that's the difficulty. Is when the dollar was ramping higher was in prior weeks, when it was becoming apparent, when it was becoming obvious, and the market hadn't priced in these rate hikes. So the US dollar already went through an enormous move, pricing in future rate hikes already ahead of time. It was pricing in some rate hikes. Did it price in enough? Did it price in too much? That's what we're now trying to determine. Not, you know, not whether or not they're going to hike. So the rookie says, "Oh, they're going to hike rates. Well, the dollar should go up." No, we know the dollar already went up, pricing in these future rate hikes. So now it's more of a debate of, does the market have it right, and that sort of idea. So I hope that makes sense. Let's go in. Which one should we pick? Let's go to a short time frame. So let's go Kiwi USD. We'll start there. And in Kiwi USD, again, on this one, I'm looking to trade it more down than up. So this would be for a US dollar strong move. And a couple of things I see on here. I mean, so we're playing this down. That's playing the US dollar to go up, like we talked about, would be the general idea. I think you're in a bit of a downward phase, right? Kind of a descending triangle, that sort of concept. So here you can see we've been in a downward trending phase, lower highs. This is on a 1 hour time frame. And maybe this is kind of the bounce before the breakdown. It's only one candle or so, but that's oftentimes, in stronger trends and whatnot, you often just rebound for a candle or two, and then it's a resumption. So that's kind of what I'd be looking at here, is just, hey, we start to roll over again, and away we go. If we're looking at this from the standpoint of risk and reward, we're just going to have to use a tighter stop. I think this is a trade that we would be looking at taking if we're basically kind of reversing this candle. So the stop would probably just be up here above the high, and we're going to get short somewhere in this neighborhood and, target a move down. So we're hitting that time period. Let's see. I don't think the actual numbers and announcement have come out just yet. Okay, so you can see Kiwi, usually when it hits, there'll be a big burst. I haven't really seen, it'll be a burst of energy, almost like the chart gaps. and I'm not really seeing that. Maybe the news is out and it's just kind of quiet. I mean, that's okay. So it is out now and 2.5. So they did hike by 75 basis points as expected. And I mean, it's a pretty big dud. So far, not a whole lot of reaction in the markets. I mean, even if we go into a really short time period, let's go into a 15-minute or something, and again, just super quiet. So there's not a lot of energy. I still think this is the trade, is to short Kiwi USD. So we could short it in this area, and I'm going to go ahead and trigger a trade right here. Short it right here at 62.06 or so. And I'm just putting my stop right up above that high. So hold on. Come back in. I've got my stop, I mean, just above the high at 62.16, so not risking much. That's probably, frankly, too tight to really be in it long term, but I'm just going to see if I can get this thing to have a little bit of an energy burst to the downside, and we're just not going to risk much. I mean, that's only 10 pips. It's just not, well, there you go. I'm going to be hitting my stop shortly because it looks like we're taking out that high temporarily. So my guess is we hit it right here in the next minute or two. And maybe we will, maybe we won't. Let's see here. Yeah, so it just hit the stop. I mean, I think that was the attempt, is to just see if this will burst a little bit in your favor. You can see what I turned to was the 15-minute chart, and it's not a great setup because you're trading on such a short time period. It's day trading is hard because a lot of setups fail, right? But the idea was we had touched that upper Bollinger Band, and so that's what I was trading off of on the 15-minute is, hey, maybe we'll just kind of fade off. And initially we did, and that's why we triggered in, but it came back the second time and pushed above it. So what does that mean? Well, the US dollar's weakening a little bit, right? Kiwi strengthening, USD's moving the opposite way. If you're playing USD to the downside, that's where I think you could trade a little bit longer time period, where you go into something like Swiss franc and say, okay, I'm really going to trade this for the next few hours, the next day or so. And that might be okay as a trading concept as well. I am nervous about the FX markets being choppy here, to be quite frank. And that's why I traded that's as tight a stop as I've ever put on in one of these classes. But it's kind of the way I wanted to trade it here, was just see if I could squeeze out a few pips, risking 10 pips, and it wasn't meant to be. Kiwi and CAD moving a bit more. So, I mean, even there, I don't know that it was really too much of a reaction. I mean, it's moving a few pips for sure, but nothing too major. I mean, that 79.95 to 8.05 is only 10 pips. That's the problem, is I don't think this was an energy move. And when you have a lack of energy, it doesn't really build confidence for trading these types of events. It was such a lackluster thing. I was sitting there debating, well, maybe they're a little bit delayed on the announcement or something, because you just didn't see anything reacting. I think about the only thing I would try for that type of energy is just that short-term trade. Just try to day trade it really, because we had a setup, we had hit that 15-minute chart setup, and is a 15-minute chart setup as good as an hourly? No. And is an hourly as good as a 4-hour? No. And is a 4-hour as good as a daily? No. They're kind of more susceptible to fail the shorter the time frame you go. If you go try to trade a 1-minute chart, best of luck to you. There's going to be a lot of failures, a lot of whipsaw and back and forth and so on. So 15-minute chart's about the shortest time frame that I'll trade, and we gave it a shot, but didn't work out. What do you think about the Bollinger Band having a 2.5 standard deviation versus the 2? It'll be harder to hit the Bollinger Bands when you widen out the standard deviations. I have heard of people trying 3 and so on, but I've never tested that. I wouldn't have a good, you know, concept of whether that's better or worse. I think you'll get a lot fewer setups, and whether those are better or work out or not, I'm not so sure. I kind of like the 2 standard deviation approach that we use, and I think that's one that I know works out over time. I'm not so sure about the 2.5, but I hope that makes sense. So we'll leave it there. US dollar, for today is a bit choppy and lacking of energy. So for this week, we had the Fed meeting. We've got the currency room recording. Remember that tomorrow morning you get advanced GDP, which markets will be closely watching and debating whether or not we're in an economic recession. So hope you've enjoyed it. Have a great rest of your day, and we will see you next time. Goodbye, everyone.